Welcome everybody, and thank you for joining tonight on our webinar that we're going to cover our investment plans for 2023. If you're just joining us, thank you for taking the time and spending this on our Wednesday afternoon. We're going to go in tonight about all of our investment plans for 2023 and the funds that we're launching. But if you have any questions whatsoever, please email us at investors@spartan-investors.com. We'll get your questions answered. Write them down throughout the course of the presentation, and we will go ahead and email you back. And then in our next webinar is on February 15th of 2022. We're going to talk about just the income fund and really dive into that. But tonight's just an overview, but we can address some questions on our upcoming webinars and our follow-up emails and things like that. So with that, we're going to go ahead and get started. So welcome to the Spartan Investment Group presentation on our investment fund plans for 2023. My name is Ryan Gibson, and I'm the Chief Investment Officer here at Spartan, and I'll be leading our discussion tonight on how our investment plans will benefit both new and existing Spartan investors. So we are planning on increasing our transparency and our education over the next month so that you can learn as much as possible about our funds, about self-storage and the industry, and how you can benefit from our investment plans in self-storage specifically. We're also going to be covering the benefits of investing early into the fund, which is set to launch on March 1st of 2023. So with that said, let's go ahead and get our disclaimers out of the way. Please note we're not providing any legal advice, and it's important that you do all of your own due diligence, consult with your own tax and legal team, and that just know that this presentation is just a general overview, and we expect to have our full offering docs, PPM, subscription agreement, etc., available on the investor dashboard in the coming weeks. We just wanted to prepare you for the fund launch in the interim so that you can have plenty of time to review all offering documents. So Spartan plans to launch 3 funds in 2023 and deploy funds in key markets throughout the United States: the debt fund, the income fund, and the growth fund. And in this presentation, we're going to cover a number of topics. Tonight we're going to look at why our continued investment in this recession-resistant self-storage industry is something that we're going to continue doing, continue investing in, and how you can benefit from our existing self-storage platform, and why we have many benefits investing with Spartan. We're also going to take a closer look at the 3 funds that we're offering tonight: the growth, debt, and income fund. And then we're going to conclude with kind of talking about the investments and how you can benefit from investing early in the fund, specifically in the first 45 days. So let's talk about first the self-storage industry and how it continues to grow and provide resilience during recessions. And if you look back over the last 20 years, self-storage occupancy has remained strong even during times where there's been declining GDP, as you see on this chart. And so, for example, in 1987, Black Monday, when the markets crashed and cratered over 30%, self-storage remained exceptionally strong. 2008 recession, the COVID-19 pandemic, occupancy held strong and experienced sometimes even growth. And that's because self-storage is based upon one thing. In addition to some business use, self-storage heavily depends on life events. During times of economic disruption, these life events increase, leading to higher occupancy, higher rates, and better income for Spartan and storage. And during the COVID-19 pandemic, specifically, self-storage was one of the best performing REITs. It outpaced all other asset classes in the space, period. And that's because self-storage has favorable tenant-landlord laws. It has no restrictions on rental increases, eviction moratoriums, as compared to other asset classes. And this doesn't matter if you're in a red state or a blue state. It's really favorable lease terms. So what has happened since COVID, and how has self-storage performed since the COVID boom? Well, when looking at the household utilization of self-storage, we've seen an increase in the number of people in the household utilization of self-storage up to over 11%. We've also seen double-digit year-over-year same-store growth in the industry. And what's interesting is that self-storage The largest demographic that uses self-storage is actually millennials. And they're also the largest demographic in the United States. So as they start to experience more life events, moving, job relocation, growing family, this will continue to drive customer growth into the future. And everybody started to take notice. Specifically, the bigger, smarter money, like Public Storage, has announced an unsolicited offer just on Sunday for Life Storage at $11 billion. And this takeover is one of the largest corporate deals so far in 2023, and they're offering a 19% stock premium for their assets and their operating a business. And rapid consolidation in the self-storage is continuing, with the big players making some very serious acquisitions. Examples include Public Storage, Blackstone, buying Simply Self Storage for $1.2 billion, and even Bill Gates getting into the quarter share acquisition of StoreMart, investment into StoreMart. And self-storage, ultimately, after all this transaction activity and consolidation in the market, was named the hottest asset class during the COVID-19 pandemic, and Spartan took advantage of consolidating the portfolio that it has by buying a lot of assets, over $250 million in 2021 alone. But most recently, the Prime Group just announced its largest self-storage fund ever, or the largest one in the industry. And that's because, as we've seen, smart money is looking to take advantage of the self-storage industry and its strong fundamentals for cash flow. So let's talk about the buying opportunities that we have in 2023. When we look at the forward curve, or what interest rates are supposed to do from 2023, from now and beyond, we see that interest rates are supposed to peak in 2023. This has made a lot of problems for smaller operators and has provided opportunities for Spartan to pick up discounted properties and aggregate smaller facilities into a bigger portfolio for a healthier profit. Now, smaller operators are facing these challenges because they can't get financing on a facility-by-facility basis because increasing rates. Also, banks are starting to slow down some of their lending. So, as the rates are up, we have the opportunity to buy these facilities with cash. And as the rates are predicted to crash and go down in 2024, 2025, we have the opportunity to refinance at a more advantageous date. If the rates don't go down, we see smart money stockpiling cash and getting ready to buy these big portfolios. And as an investor, you'll benefit from our existing portfolio, which is what larger groups want. This specifically is where all of our current assets are throughout the United States. Now, Public Storage is attracted to Life because it's got massive market share and it wants to grab that market share and take advantage of it. And as the 40th largest operator of self-storage in the United States, Spartan has become a go-to investment shop that is desired by the smart money and investors looking to take advantage of cash flow and upside potential. And our exit strategy really can be summarized in one way: optionality. We have the potential to increase returns and invest in multiple different exit strategies by breaking up the portfolio into multiple sales. We can sell properties individually. We can sell the whole thing to a REIT. We have the optionality in the future, which is great. Now, we like to think of ourselves as kind of a portfolio aggregator of sorts. We go out as a medium-sized fish and we buy a lot of small mom-and-pop operators that a lot of other bigger investment shops wouldn't otherwise buy. Now, I mentioned we're the 40th largest operator. There's 39 much larger operators that are looking to take what we've purchased and aggregate it into portfolios and write a bigger check for it and buy our portfolio. Now, I don't like having one exit strategy. We don't like having one exit strategy at SIG, and we highly encourage multiple exit strategies. Now, what we've found is that we're not limited to bigger players in the space. Smaller local operators are also interested in buying these one-off properties from us. 1031 exchanges, maybe they have a couple of properties in the region where we pick up a property, and we've seen multiple exit strategies play out here at Spartan. Now tonight, I'm going to introduce the 3 funds and the details on each one. Now all these funds and their information, you can go to spartan-investors.com, you can go under our offerings tab and see the different funds. But we're going to talk about the power and how we can provide excellent potential returns for you as an investor looking for the absolute best return, cash flow along the way, or a combination thereof. Now, continuing on the success of Spartan Storage Fund 1, I'm going to talk first about the income fund, but all these funds have a $50,000 minimum, and they're open to accredited investors only. Now, back to the income fund. I'll begin with an overview of the income fund, which is much like Spartan Storage Fund 1 last year, and the income provides the opportunity for accredited investors to earn monthly cash flow, upside potential, and the benefit of depreciation. The income fund is going to target value add and core plus self-storage facilities that generate income from day one. Now, some sample assets you might wonder what would go into Spartan Income Fund, and this is the assets that the Spartan Storage Fund 1 targeted and acquired last year, and we expect to buy very similar assets as Spartan Storage Fund 1. These are facilities in secondary and tertiary markets around the United States that were existing, and they provided positive day one income that in return provided consistent cash flow and upside potential to our Fund 1 investors. Now, the targets for the income fund are $240 million in total purchases of existing properties. We're looking at 15 to 25 properties in secondary and tertiary markets throughout the United States, and that's going to require $75 million total raise. Now, how we get these is our acquisition team identifies facilities both on and off market, and they may be priced below market or have market rents that are below market that provide great return to our investors. Now, this enables us to execute our value add strategy, which includes things like improving the facility automation, adding ancillary revenue streams. We increase the staff training, and we improve the property to provide a safe, secure, well-lit facility that is in line with our national brand standards. And so overall, the income fund is going to benefit our investors who want passive income and upside potential. So let's talk about cash flow on the income fund. The income fund can expect year one cash-on-cash return of between 4% and 5%, and increasing each year after to approximately 8% cash-on-cash return. We send all of our distributions to investors on a monthly basis, and we expect cash flow to begin 90 days after your funds are activated in the income fund. Now, overall projected returns are expected to be between 14 and 20% annualized when you count the cash flow and the profit from the sale. And all of these the equity funds have a 5-year target hold, and the projected IRR is between 13 and 18%, and that rolls up to a multiple range of between 1.7 and 2.2 times equity multiple. Now, there's 3 share classes for investors, for passive investors. There's Class A, B, and C. And these, I just want to kind of quickly talk about the incentive for a larger investment amount or investing early, or both. So those who invest in the fund in the first 45 days of the offering are going to benefit from a stepped up share class, which positions the investor for better returns and overall split, affording more benefits such as depreciation and income, things like that. And so all investors benefit from a preferred return that's going to accumulate daily, and your preferred return accrual begins when the funds are deployed in the fund. Now, share classes are as follows. I'll start with Class A members, who are those who invest a minimum of $50K and a maximum of just under $1 million. Class A investors are going to get the benefit of a 7% preferred return, 70-30 split until achieving a 14% annual return, and then a 50-50 split thereafter. Now, Class B investors are going to get better returns and a better preferred return. They are investors who place $1 million or more in just under $3 million. They're provided an 8% preferred return, the same 70-30 split until achieving a higher 15% annualized return, and then a better 55-45 split thereafter. So better preferred return, better 70-30 hurdle, and a better back-end split. Now, Class C investors are the best investors who invest a minimum of $3 million or more, and they're provided with an 8 pref, or 8% preferred return, 70-30 split to a 16% annual return, and then a 60-40 split thereafter. So the best splits and returns on the Class C share. And like everything, funds are accepted on a first-come, first-served basis. So let's talk about, again, the benefits of investing early. This chart represents the 3 share classes that I just described, Class A, B, and C. That's what those 3 lines are. And it's going to give you the differences on what a Class A investor would get versus B versus C. And as you can see, generally there is a 1 to 2% annual return that's better, or roughly 5 to 10% better total return if you're investing in a Class B or C share respectively. And as mentioned previously, an early investment is provided a stepped up share class, meaning that if you invest $50,000 in the first 45 days, you get the benefit of a Class B, and likewise if you invest $1 million, you would get the benefit of a Class C. So with that, let's jump into our second fund of the presentation, which is our growth fund. Now, the growth fund is focused on ground up developments, or those facilities that have the greatest return potential. And at Spartan, our formula for growth is simple. We only seek the best self-storage markets in the prime locations, which provide tremendous value to our investors. But the way to add the most potential upside is to build a facility from the ground up. And as a growth investor, you can benefit from all the experience and gain the greatest potential upside as we leverage our in-house construction company and team who entitles, permits, and builds self-storage in areas where storage demand outpaces supply. So while the fund doesn't really target monthly cash flow, it just focuses on those more opportunistic investments that will deliver the potential highest invest returns to our investors. Now I'm going to quickly show an example of what the fund would buy. This facility here was raw land just south of Seattle that we fully entitled, permitted, and built a brand new Class A facility that has 755 units and a tremendous equity build for our investors. Now this is what the growth fund does. So obviously there's not going to be cash flow while we're building raw land. But when we build it, we build a ton of equity potential for our investors. And for those who have known us and have invested since the early days at Spartan, ground up development has been at our core. We have a solid track record of success, and we've built in some of the most challenging markets, from developing in our nation's capital to building where rezoning, wetland mitigation, extensive entitlement, and challenging construction conditions were overcome by our team. And the growth fund, to kind of give you an overview of it, is targeting $100 million in new total project cost, which represents about 8 to 12 ground-up developments or facility acquisitions, and that represents raising about $45 million for the fund. The target returns for the growth fund are going to be higher than the income fund. We're targeting a 19 to 26% annualized return and a 5-year target hold with an IRR of a target 15 to 20%, which all rolls up into an equity multiple of 1.9 to 2.6 times equity multiple. Now, I'd like to say that in the history of all the offerings we've ever made, the splits to investors in the growth fund are some of the most favorable limited partner splits that we've ever achieved. And what we're going to talk about is what those splits are, but I'd first like to talk about the benefit of the liquidity preference that we're offering to investors. So all growth investors benefit from the liquidity preference, meaning that investors will receive 100% of the sales profit to either 12% for Class A, 14% for Class B, or 16% annualized for Class C at the eventual sale before any splits with Spartan. So let's talk about the Class A members first. Class A members are those, just like the income fund, that invest between $50K and $1 million, or just shy of $1 million. And Class A investors get a 12% annualized liquidity preference and a favorable 60-40 split thereafter. 100% of the profits to a 12% return, and then a favorable 60-40 split. Class B members are those who invest a minimum of $1 million to a maximum of just under $3 million, and they get a 14% liquidity preference and a favorable 65-35 split. Class C members are those who invest $3 million or more. They get a 16% annualized liquidity preference to a 70-30 split. And for those who are wondering about our previous deals, the highest liquidity preference we've ever offered is 10%. So the fact that we start at 12 and go to 16 is incredible. And like all other funds, investors are going to benefit from funding early. So those who invest in the first 45 days get an elevated investor positioning or a higher share class, leading to higher potential splits. And we accept funds on a first-come, first-served basis. So this chart, again, it represents 3 lines, 3 different share classes, and it's going to highlight the differences between the different share classes in the fund. So this one actually gets better splits than the income, and that you're going to get 2 to 3% per year better splits, or a total of 10 to 15% better total return if you're investing as a Class B or Class C, respectively. Now, as mentioned previously, early investment is provided a stepped-up share class. So if you invest as a Class A, you get a Class B, or Class B, you get a Class C, if investing in the first 45 days of the fund. So that wraps up our growth fund. Very excited about that one this year, as it offers a different investment risk tolerance and profile to our investors. So the third and final fund of the presentation is our Spartan Storage Debt Fund. And the Spartan Storage Debt Fund really caters to those investors that are looking for immediate, consistent, monthly cash flow in a lower risk environment. And as a debt investor, you're going to benefit from a redemption option that's available for those looking for kind of a more flexible investment opportunity. Now let's talk about the targets. The fund targets raising $60 million of debt and paying 8 to 9% per annum returns that are distributed on a monthly basis. And the 8% per annum return is for those who want a redemption. 9% is for those who don't desire that. And we provide the opportunity to put debt on our existing assets and future acquisition targets. So let's talk about where we invest. We're going to stay in where we know the best, secondary and tertiary markets. We look at investments that have strong job growth. We look at places that have strong net positive migration. And we're looking for unmet demand in storage markets with rent and income growth opportunity. But most importantly, we look at where our existing facilities are, and we benefit from our economies of scale. So let's talk about the funding process. At the time that you commit to the investment, we accept funds on a first-come, first-served basis. So when someone is first in, they get first deployed. And so we call 100% of your capital at the time you commit to investing. And then once the funds are actually used for the purposes of buying property or paying expenses inside the fund, 100% of your capital gets deployed. So we use that across the entire portfolio. You benefit from all assets in the fund, and you get the original cost basis regardless of when you get into the Spartan Storage Funds for 2023. And then the income fund distributions are going to begin 90 days after your funds go active. The debt fund distributions are going to begin the following month after you place your capital. So that kind of wraps up our presentation for tonight. You can see on the screen here I've got a QR code. This is how you sign up for our wait list so that you are the first ones that get a crack at investing in the fund. So if you want to be first in line, get the first news that comes out, sign up for our wait list. And you can also go to our offerings page, spartan-investors.com. Click on our offerings. You can see different videos, different information about the funds as we progress. I also wanted to say that we will have multiple education opportunities this month, February 15th, February 22nd, and March 1st, where we dive deeper into the specific funds and talk about how it's structured and the targets that we're trying to achieve. Now, if you have any questions, just simply email us at investors@spartan-investors.com. We will get to your questions as soon as we possibly can. In the subsequent emails that we're sending out and webinars that we have, we'll host a Q&A. We're also building a Q&A document that will be posted on the fund pages and sent to you and put on the investment portal. But with that, I wanted to first thank all of our existing investors who have made Spartan possible, and also wanted to thank new investors for tuning in tonight. And we look forward to potentially partnering with you in 2023 and beyond. Thanks, everybody.